When you make the decision to invest, you also make the decision whether to invest the way it's always been done or to invest in a new modern way. Now, the old way was more about just beating the market. This new way is more about reaching your goals. And joining us on the phone from Dublin, Ohio is my guest, Greg DuPont. Greg, thanks for joining us. Start out by comparing these two different schools of thought.
Well, the modern consumer has kind of been sold a bill of goods over the years by it being directed into modern portfolio theory. That's where we have the pretty little pie charts that show that you've got enough in different market sectors, enough in stock and bond. And if you simply hold the course and stay invested and rebalance on an annual basis or more frequent basis, regardless of what gyrations go on in the market, you'll be okay. Well, we've seen that has failed fundamentally in the last several market corrections now, leaving the investor that has followed that model to significantly lose value. And once money is lost, it is lost forever. So the modern investor has to look for a different path. And we believe that path is using what we call tactically managed funds.
So, Greg, clarify now the elements of this new modern strategy.
What we're seeing is there are a growing number of managers that are making available to the investing public strategies that look to what's happening in the current market economy and where that market economy is heading, as opposed to looking backwards as to what happened. For example, when you're looking at a track history on a mutual fund or something like that, that is always looking back and putting a big disclaimer that what happens in the future can't be predicted by what happened in the past. But that's always been the basis for a allocation in the portfolios that the modern consumer has been forced to take.
So you often talk about the importance of having a financial advocate. Explain that.
I believe that the modern advisor, the fiduciary, the advocate, as I argue for, has to have what we like to call a no sunk cost mentality. We have to walk into the office every day and say, hey, what I did yesterday may not be good enough. What do I need to do today? What needs to be done tomorrow to take care of our clients? And what we have done is we have found money managers that take a similar approach and are always looking to what tomorrow is bringing to try to make sure that we have the best solutions in place. What I had done for clients in terms of portfolios just 18 months ago may not be the best solution now, let alone what I was doing 12, 15 years ago. And that's the attitude that we need to have, and that's what advocacy is all about.
Greg, one of the traditional investment strategies is something that Warren Buffett has said he did, is buy and hold. And you say that really doesn't make sense now, does it?
If you look historically at, what were the great companies that a Warren Buffett would have invested in back in 1980, 1990, 2000 even, and how many of them have gone out of business or otherwise have suffered significant loss. That in and of itself gives you some evidence as to how that buy and hold philosophy just does not hold as the basis for most investors. And if you look at what Buffett does as opposed to what he says, he's much more active in what he buys and sells than the common investor thinks he is.
Now, what should the modern investor be focusing on?
Yeah, there's one other part where I believe that the modern investor needs to be more deliberate in their view of what they should have in their portfolio. The modern portfolio theory and the general strategies that have been used over the years were developed in large part based upon a time when the investor could rely upon a bond component of their portfolio being a sound contributing baseline of growth for that portfolio over time. As we sit here now in this decade, in this market economy, we are more likely to be looking forward into a period of time where the interest rates continue to rise, which makes the bond values decrease, which means if you have that as a significant part of your portfolio, you're facing a losing proposition for that component of the portfolio as opposed to it being a baseline of growth. So we're seeing that the modern investor that relies upon having that traditional fixed income or bond component of their portfolio is in a situation where they have actually more volatility by having it as part of their portfolio.
Greg, finally, what is a good alternative to bonds right now?
Well, Scott, the industry has developed a solution that really needs to be reviewed by anybody that has accumulated funds and are looking to save for the future, and that is a fixed index annuity. Now, that's a whole conversation for another day, but that fixed index annuity, as it has evolved over recent years, has become a very strong solution for people that want to have some reliable growth in their overall portfolio.
Joining me on the phone from Dublin, Ohio has been Greg DuPont. And thanks for watching Retirement News Online.